Good afternoon, everybody, and welcome. And thank you for joining us this afternoon for the latest installment in our ongoing webinar series. My name is Derek McPherson. I'm a Vice President and Mining Analyst at Red Cloud Securities, Inc. And today's presenter is Vox Royalty Corp, a newly listed royalty company that has a disruptive, data-driven approach to building its royalty portfolio. This new approach is actually why we like the company and why we recently initiated with a buy rating of 475 target. In the chat, you can see a link to our most recent research on Vox. Presenting today on behalf of the company is Chairman and CEO Kyle Floyd. The format for today's webinar: Kyle's going to give us a bit of an overview on Vox and what we have to look forward to from a news flow perspective for investors, and then we'll take your questions live. And I have some questions of my own, some key points that I want to hit on with Kyle. So we will. We'll have an in-depth view of who Vox is by the end of this. To start with, we'll get the exciting part out of the way and handle the disclosures. So for Vox Royalty, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of Vox's corporate presentation, which you can find on the company's website. For Red Cloud Securities, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. For our company-specific disclosures on Vox, please see our most recent research commentary on the company, and you can see that on the link I provided. So with the exciting part out of the way, we'll turn it over to Kyle to give us a brief overview on Vox, and then we'll get into your Q&A. Thank you.
Terrific. Well, thank you, Derek, and thanks to the Red Cloud team and everybody tuning in today. It's a pleasure to be with you and presenting the Vox opportunity to you. It's an exciting time in our company's history. As many of you may know, we are a newly listed publicly traded royalty company. That being said, we've been around since 2014, building the foundation for what we believe is going to be a very significant royalty company going on into the future, where we're driving significant value for our shareholders, really at unprecedented levels. The company, as I mentioned, was founded in 2014, really going back to the basics of how to create a royalty company that was going to be successful for investors over the long term. And there were a couple key principles that we built around. One was intellectual property, and we were successful in acquiring that and building that. We acquired a database of over 7,000 proprietary royalties as part of our acquisition of Mineral Royalties Online. We also went about creating deal sourcing and deal relationship networks around the world in far-flung jurisdictions where our competition wasn't. And we built around a technical team at the front lines of our business so that we were able to truly understand asset quality first, royalty overlaying that asset, and the third principle obviously being value. And we've done that to build long-term value in a sector where, when that's been created, immense shareholder wealth has also been created. Since 2019, we have been the fastest growing royalty company on the planet. That's bar none, that's no asterisk. Vox Royalty has been the fastest growing royalty company. We've amassed a portfolio of 42 royalties and streams that's achieved critical mass in many ways, both in terms of development stage assets moving into production and also exploration assets, providing very significant upside for our investors on an organic basis. There's more than 120,000 meters being drilled on our royalty portfolio today that we don't pay $1 for. 75% of our assets are in Australia. That's both design and organic, and presents a very interesting opportunity for our investors in that it's a great low-risk geopolitical jurisdiction, but also the tailwinds as far as what's happening on the ground in Australia in terms of development, especially in the gold space where we have a lot of royalties, is adding a significant amount of value for our royalties and for our investors. And then lastly, we have the deepest pipeline in the industry. One of the things that we say quite often is we pass on more royalty opportunities than likely any other company in the industry. And that gives us the benefit of being able to be very selective about what transactions we close and bring into the portfolio for our investors. Vox is a very significantly precious weighted royalty portfolio. That's both organic and by design. Our investors have asked us to focus on precious metals. So we absolutely adhere to that and focus on precious metals. It will always be a significant weighting for us. We also focus on low geopolitical risk jurisdictions. That gives our investors very good diversification of risk and opportunity for upside long into the future with solid jurisdictions. We're realizing exponential growth in all the categories that matter as a royalty company, both in total volume of royalties, exploration assets moving into development, and development assets moving into production, and producing assets increasing in production. To complement this very exciting portfolio, we have a very tight capital structure, no debt. We have enough cash on the balance sheet to sustain and build our business for the foreseeable future. And we're excited that we have very strong support of our existing and new shareholders that continue to come on the register. There have been a handful of the who's who in terms of gold funds that have joined the register recently and continue to validate and appreciate the business that Vox continues to build. As I already mentioned, Vox really built around a technical team at the front lines. We have some of the most significant and deep experience at the technical side of the equation of any of the emerging royalty companies in the industry today. 3 of our 4 key business development executives have hands-on mining expertise at the technical levels, working for some of the most interesting operations around the world, from Australia to Asia to Africa. And it's complemented by also a deep financial background as well. The team collectively has almost 40 years of experience specifically in the royalty industry, which puts us at a significant advantage in the industry compared to many of the new entrants over the last few years. We have a team of 6. We're well positioned around the globe to position us in front of as many royalty opportunities as we can in the major mining markets. That also adds to our ability to see just frankly more royalty opportunities than anybody else in the industry. The portfolio is heavily weighted to Australia, also heavily weighted to precious metals. That's as much organic as it is by design. One, there are just more precious metal royalties out there, as gold has really been the most explored for commodity since the beginning of time. And it's when tenements change hands that royalties are typically created. So there have been more gold exploratory tenements that have changed hands, creating more gold royalties. To complement that, we have a database of over 7,000 royalties, almost 1,500 of which cover Australian opportunities. And Australia was really a jurisdiction that many years ago we decided to focus on, as most of our competition was focusing in the markets of Toronto and Vancouver. We built a very significant presence in Australia. It also helps that 3 of our 4 key senior executives are also Australian citizens. But our intellectual property, our deal sourcing relationships, and truly the quality of what we believe is the best mining jurisdiction on the planet allows us to build a very exciting portfolio of royalties at very deep value, where there's less competition and exciting opportunities continually that we find and bring into the portfolio. You'll note that we have immense growth in terms of producing assets and the growth of our producing assets. We went public with 2 production stage assets. We're now at 5 production stage assets when you count a very meaningful gold project that's in construction to date. And we expect that to be between 7 and 8 producing assets just on a pure organic basis with what's already in the portfolio by the time we exit 2021. That does not count the acquisition pipeline that we have, where there's an abundance of near-term revenue producing opportunities. Vox has been the fastest growing royalty company, and it's rather unprecedented growth in an industry that's rewarded growth. However, it's not growth for the sake of growth. It is growth at truly better value than almost anybody else in the industry. It's essentially a rewind to prices that would have been paid 10 or 15 years ago for royalties. We're able to deliver that for our investors because of the competitive advantages that we sowed many, many years ago, before the royalty space was as in vogue as it is today. We saw the competition coming. We knew it would be there. Royalty companies have tremendously outperformed and overperformed most commodity-based benchmarks. So we went about building these competitive advantages patiently with immense resources, time, and capital devoted to them. And that's paid huge dividends for the business and our shareholders. Our focus is on bilateral opportunities. We look for opportunities where it's us and the royalty seller, where our time is maximized and the opportunity is maximized. We find these opportunities in these bilateral situations through the intellectual property, the database of 7,000 proprietary royalties, but also our deal sourcing relationships around the world. In many cases, we know about royalties that others don't, and we're also able to find the royalty holders that others, even if they knew about the royalty, are not able to find. And so what that means is we're finding great royalties from interesting counterparties at great value for our shareholders. When Vox was building its business, we really looked at what we tried to distill the value of royalty companies. What did the highest performing royalty companies do better than anybody else? And we brought that into our businesses as our foundational principles. The biggest thing that you can do as a royalty company, in our opinion, is have technical analysis at the front lines of your business. We want to be believers in the asset first and foremost and looking for opportunities at the asset level before we're looking at the overall deal. It might sound like common sense, but the industry has typically been the reverse, where it's royalty companies falling in love with deals and then doing the asset due diligence second. The first thing we do is we look at the quality of the asset. We have the technical team with years and years of hands-on experience doing the first pass and the deep technical dives on these opportunities, allowing us not just to find great value as it stands today, but as we project out the growth of these assets over the coming quarters and years, we're finding truly great value across the spectrum. The other key tenet of Vox is that we typically avoid broker transactions. The rise in broker transactions has significantly skewed value towards the mining companies and away from the royalty companies. And there are still instances where value can be found by royalty companies, but royalty companies need to be much more pragmatic in where they're finding value in those types of situations. And we generally avoid them unless we're going to find deep value for our shareholders. We also avoid paying for neurology. Royalty companies have been rewarded for growth, and we've seen over the years royalty companies taking big leaps of faith in terms of unproven geology and unproven assets at very high prices. When we are considering an acquisition, we're looking for opportunities where there's enough information for us to know that we're finding great value for our shareholders. And that's usually very difficult to do in pure neurology situations. And what that leads to is very significant underlying growth in the portfolio at an organic level. We have over 120,000 meters annually being drilled on our portfolio. That's both in production stage assets and exploration assets through that continuum. And what that means is we have a lot of very interesting assets. 120,000 meters is highly significant. That puts us really ahead of many of the peers and entrants in the space that have come in over the last 5 or so years, and positions our investors to really realize appreciation in the portfolio in a situation we're not putting another dollar out, and should eventually yield a re-rating in our stock and our stock price. One of the very significant competitive advantages that we hold is the intellectual property that we acquired from Mineral Royalties Online. We paid a very significant amount of money for this database. We've been utilizing it really since 2019, and it's the synergies of a technical team, deal sourcing relationships around the world, and this IP that's really enabled us to find amazing royalties held by counterparties that you'd never expect to be holding a royalty, whether that's doctors in villages in far-flung jurisdictions, to telecommunications companies that were previously mining companies that generations ago changed businesses, to hearing aid technology companies and or prospectors that have held interesting royalties, sometimes for generations, that we're able to find that the market either doesn't know about or is completely forgotten about. And there are many royalties in our database that have come from these esoteric places that have added a significant amount of value for our shareholders and for our business. One of the key principles of Vox and how we continue to build our business is we look for opportunities that are going to grow organically. Where we buy them is not where they're going to end. And we've been very successful in that. And when we went public, we had a lot of questions around, well, what does the Vox portfolio look like 12 months, 18 months, 24 months from now? And we said, our portfolio is going to be very interesting in terms of its growth of development stage assets into production, both from an acquisition basis and an organic basis. And we've delivered that, and we focus on that. So our portfolio went from 2 production stage assets to now we're sitting close, well, it'll be 5 production stage assets when construction finishes on Thor Exploration Segilola gold project. And we expect for that to be between 7 and 8, possibly more, producing or production stage assets as we exit 2021. That's highly significant growth for a company the size of Vox, and we're excited about what the next 3, 6, and 12 months holds for our portfolio and for our shareholders on this basis of growth in terms of producing assets, and what also yields very significant revenue growth as well. One of the more significant things that often gets overlooked is the depth of the counterparties and the diversification that this provides for Vox. As many of you know, we're not the operator of mines. We rely on the operating companies to develop their assets and bring their assets up the curve and do that successfully. And we've been very pleasantly surprised as we have this great diversification of operating partners that, with a lot of wind at their back with the commodity prices increasing, they've been able to bring their assets up the development curve faster, whether that's exploration, increasing resources or reserves, or development stage migrating towards production, or production assets increasing in production. Our portfolio of operating partners is overall very well financed and capitalized and well incentivized as well to move their assets aggressively up the curve. And we've seen that play into our portfolio where we've realized a lot of growth that exceeded our expectations. So we have the benefit of a significant amount of risk diversification, but we're also seeing even more so a lot of unforeseen upside within our portfolio, whether that's world-class assets or presumably what may be world-class assets being proven out, all the way to very significant assets for us increasing in production. We've been very pleasantly surprised with upside in our organic portfolio across the operating parties that run these mines. Very quickly, we have some very interesting assets in the portfolio. These are only 6. We don't have time to talk about the 42 and growing royalties that we have in the portfolio to date, but at a high level, there's some to touch on that give you an idea of how we go about sourcing our opportunities and the value that we're continually bringing in to our portfolio for our investors. The Koolyanobbing iron ore project is a very interesting asset. We acquired this royalty that covers the Deception Pit from a telecommunications company. The telecommunications company had historically been a mining company that held this royalty, and then over the years had become a different business. And it was more or less a forgotten royalty that we were able to find and execute on a bilateral basis, bringing in this royalty to the portfolio. It's very significant. It's in production now. It's growing in production. We start getting paid on this royalty probably mid next year as a previous hurdle was in place that had been paid to the previous owner of the royalty. That also helped us acquire this royalty at great value. And so it'll be a very significant revenue producer for us mid next year and beyond. Segilola is a very interesting gold project. It's one of the highest grade open pit gold projects in all of Africa. We bought this royalty for a fraction of NAV on a very interesting project that should be producing. It's in construction now and should be producing revenue for us mid next year. Bowdens is Australia's largest primary developing silver project. We found this royalty through the database. It allowed us to basically get a transaction done for great value with a counterparty that was very inclined to take our stock and partner with us in terms of unlocking value on their royalty within a royalty company. We're excited about this project. Silver prices going up means there's a lot of leverage for us with a project like this. Ashburton was a royalty. It is really an elephant within our portfolio. The value is just starting to be unlocked there. When we bought it as part of a portfolio package that we acquired, closed when we went public, this royalty was in the hands of Northern Star, which is a multi-billion major Australian gold producer. As much as this is an elephant for us, it was a little bit subscale for Northern Star. And so when they sold this very large resource and very high grade opportunity to a company called Kalamazoo Resources, it unlocked a lot of value for Vox, and that there's a lot of drilling being done on this project, and we expect a lot of near-term organic news flow and growth on this asset. And again, it's elephant potential for us. It has very significant revenue implications for us looking out into the future on what can be a very quality asset. Dry Creek is a royalty over some of the Higginsville operations run by Karora Resources. This was a 1992 forgotten about royalty, again, found through our deal sourcing and intellectual property. It was acquired at great value. It has immense upside. It's a royalty that we expect to be generating very serious organic news flow for us. We're expecting a resource upgrade from Karora, the operator, here over the next quarter, which should continue to prove out the value of this producing operation for us. And then the last royalty I'll touch on really is just a testament to the IP that we have in our deal sourcing networks, especially in Australia. This was a royalty held by a hearing aid technology company of all businesses that when we approached them and said, there's a royalty that we'd like to buy from you, more of our time was spent convincing them that they actually held this royalty than negotiating the purchase price and conditions of the acquisition. It turns out we looked at this asset very favorably. We believe that there was a case for this to be in production very soon. That is playing out, and we believe this asset will be in production next year. And for the purchase price that we acquired at, it's great value. We paid about $200,000 for this asset that we expect to cash flow more than $200,000 per year for us for some time. Vox is very pragmatic about our approach to our business and the capital markets. We view the relationship with our investors as partnerships. We've built deep trust and deep relationships with our investors since we've been a private company and now as a public company, where when we say we're going to do something, we are very disciplined and focused on delivering those catalysts for our investors and doing exactly what we say we're going to do, and hopefully exceeding those goals that we set for ourselves in the market. We continue to do that. We've been focused on driving value for our shareholders. We're seeing that now with the organic news flow and developments in the pipeline, that for no additional capital outlay is driving immense value for our shareholders. We will continue to be focused on delivering what we say we're going to do for our shareholders. And we believe over time that relationship will continue to build, and we will continue to find more support in the public markets. So why Vox and why now? Vox has one of the most catalyst-rich portfolios of any royalty company, not counting our industry-leading transaction acquisition pipeline. We are driving more value from a fundamental portfolio right now than really anybody else in the industry. And that's in all the categories that matter. That's exploration, increasing resources, increasing reserves, moving those projects up the development curve, and then development assets moving into production and producing assets increasing in production. That portfolio is going to drive immense re-rating potential for our investors. We trade at a very significant discount to the peers. It's hard for us to argue that there's any fundamental reason as to why. So we expect that over time, as we become more seasoned as a publicly traded business, that will in fact take care of itself, and the value that we're driving for our investors will be rewarded. And over the next 3 quarters, and really over the next quarter, there's immense catalysts in terms of new drilling, new results that I think is going to shed a lot of light on the value of our portfolio for our investors. We're excited about what the next quarter holds. There's also a very deep pipeline of acquisitions that's going to continue to build the value and opportunity for our investors. And we're excited to be on this journey with you as we continue to build immense value in the Vox portfolio. With that, Derek, I will hand it back to you for Q&A.
That's great. Thanks, Kyle. I think we've got a couple questions coming in on the chat, but I think I'm going to start with one of my own first, and I think it's an important one. The reason people like to invest in early stage royalty companies is that the trajectory of organic growth, each subsequent deal, which doesn't have to be a sizable deal relative to the overall royalty space, but is sizable for that company, creates this trajectory and creates this growth profile. And obviously, royalty companies are the model of financial engineering. You can buy something at less than NAV, and you can get paid more than NAV for it by the market. But royalty companies are, in the end, end up being judged by the acquisitions they make and the price they pay for those acquisitions. Each royalty company tries to have its own angle or niche as they come out. maybe talk about what sets you apart from this latest crop, which is there's another 4 or 5 that have just sort of come up of new royalty companies, and how your pipeline of growth is going to differ from others.
Yeah, Derek, that's a really good question. And it really kind of goes back to the beginning days of Vox, and really collectively as a team, the almost 40 years of royalty expertise that we bring to the table for our shareholders and for our business. The reality is we were in the royalty sector long before it became as in vogue as it is today. And we set about building the principles of our business in such a way that was going to give us competitive advantages, not just now, but deep into the future. What you're seeing right now is a lot of companies coming to market with really no fundamental edge in terms of how they're growing for their investors, other than putting very high priced bids on the table for royalties that get shopped. We built through the intellectual property, we built through the deal sourcing relationships around the world. And I'll give you an example of a couple of those. The database helps us unlock royalties that most of our competitors are completely blind to. But then our deal sourcing relationships and our networks in these far-flung jurisdictions, whether it's West Africa, whether it's South America, whether it's even Australia, you might know a royalty exists. In a lot of cases we do and others don't, but let's say we all knew about it, doesn't mean you can find the owner of this royalty. And so the synergy that we unlocked with our intellectual property and our relationships around the globe, designed specifically to help us get exposure to the underlying owners of these third-party royalties, has allowed us to unlock immense value. What you're really seeing in the space right now, and then complementing that, is the technical team that really looks at asset quality first, and then that dictates where we spend time and resources and capital and how we find such great deals. We've been very successful with the deals that we brought into the portfolio. That's not by happenstance or luck. That is through what we've been building now for 40 years of collective expertise in the space. Contrast that now with a lot of the new entrants that say, similar to another industry that outperforms, they look at it and they say, well, why can't I get into that? And there are traditionally very low barriers to entry in the royalty space that I think is going to make it hard for some of these new entrants to grow at good value, as we have been able to offer and deliver for our investors.
Right. Well said. The next question is one from our audience, and I think this fits right in with the theme of growth. Is the questions from I apologize, Roll, for mispronouncing your name, but from Roll, is $8 million in cash enough to grow?
It is, and to kind of I think kind of further develop that question a little bit, we have filed a shelf. It's a $200 million shelf. Right now, we're very well capitalized to continue executing the business and growing in the fashion that we have. We stretch the balance sheet with a combination of both issuing equity directly to the owners of these royalties, and then also stretching cash. As you know, Derek, we're expecting very significant growth in terms of our revenue. So we're very well positioned as we stand now. That being said, we did file a shelf as there are very significant, very large transformational opportunities that we know are coming into the market over the next couple of years. And we wanted to be well positioned if we saw value in one of those opportunities to be able to transact. And so while we have no near-term expectation of raising capital, if and when the opportunity presents itself that's truly transformational and great value for our shareholders, we will draw down on that. But there are no, at this stage, plans to do so.
Sure, and I guess just on the shelf, and I guess that's the key point there, is that you plan that you're using that as a transaction linked vehicle. You just need it in position so that you can move quickly on a transaction.
Absolutely.
Okay. Speaking of transactions, with commodity markets starting to move upwards, the underlying operators have better access to capital than they say they did even 12 months ago, let alone 18 months or 2 years ago, obviously making them less likely to take on royalties or create new royalties. What about Vox's approach insulates you from this sort of potential decline in deal flow?
Yeah, Derek, another great question. The reality is Vox's business centers around buying third-party royalties. So royalties not held by the operating party of that mining operation. And what that means is we're not actually giving capital to the mining company to go develop their project. We're purchasing royalties, and if you want to call it a secondary market, you can call it a secondary market. But so we're not competing on a cost of capital basis. If you look at the majors, that's a very important question that they get asked, and it's a little bit more relevant to them, because to move the needle at a multi-billion-dollar level, say someone that's a $30 billion business, a lot of their growth depends on funding the development of very large mining operations. And so they're competing on a cost of capital basis to have a stream form one of those components of financing, where that doesn't impact us as much. Don't get me wrong, in some cases with a rising gold price environment, rising commodity price environment, seller expectations do go up a little bit. But I would say that doesn't impact it quite us as much, especially when we're buying royalties that are not the core business or core asset from these individuals or from these companies.
Right. Now, obviously, this was a strategic decision that was made long before the commodity price started to move. What made Vox decide that third-party sourcing was a better route than royalty creation?
Yeah, we believe that there is generally a negative selection bias in terms of financing mining companies at a streaming origination level. We call that origination financing, where we're able to find royalties where the underlying mining company would never issue a royalty for any amount of money. We're basically able to find better assets where it's not competition for financing that company for good reasons or for bad reasons. We're able to find opportunities. We have a royalty over Mineral Resources. It's a $5 billion producer of a number of different commodities in Australia. We have that royalty over the Deception Pit. Mineral Resources would never put a new royalty over that project for any sum of money. Same with Karora Resources and their Higginsville operations. They're actively buying back every royalty that they possibly can over those Australian operations. Meanwhile, we have a royalty because it was held by somebody else for many years that we're able to get exposure to, that we would never, in a sense of offering capital to a mining company in return or for originating that royalty. So for us, it allows us to expand the universe of possibilities where we can find royalties over great assets.
Right. Okay. Now, I guess on that basis, taking about unearthing these royalties and finding them in unique places and finding unique sellers. Can you tell us a little bit more about your process, without giving away the secret sauce, but a little more about the process of how the database sort of functions, and then why it works, and then why you're able to consummate these transactions?
Yeah, I do have to be somewhat careful in kind of disclosure around such a significant competitive advantage and true intellectual property for us. But what I can tell you is the database was built through primary data and first principles. This was really a decade-long project of finding resources at really a hard data level that we could bring in and create a systematic platform around, and we've done that. And so the primary data for us is royalty references, and then overlaying that with both where the properties lie, the tenements that royalty applies to, who the owner is, and then spatially evaluating that so we know exactly, does the royalty cover, say, 50%, 100%, or 0% of the known resources or reserves. We also use really kind of on the ground intelligence to kind of dictate where we're pushing on that database. We look for intelligence in terms of what projects may be interesting over the next, over a rational time horizon. Again, I don't want to go into too much detail about the secret sauce of some of our business, but then also we use really on the ground relationships that help us find some of these owners of royalties that are in far-flung places. We have LOIs in place with gentlemen that are in villages, for example, on projects that even if you knew the royalty was there, and these are some really world-class projects that even if you knew it was there, you wouldn't be able to find the people that we're finding or the counterparties that we're finding. So it all kind of works together. It's not just that we have intellectual property. It's not just that we have deal sourcing relationships and a technical team. It's the interplay of those three main kind of legs of the stool that that allow us to do a lot of what we do.
Sure. On the database, we have a question from John on the webinar. Are you able to update the database in close to real time? So I guess how does the data? I guess that's really a question: how the database evolves over time. Is it as you become aware of new royalties, they get layered in, or is it something that is sort of a little bit static and that you're just you're literally mining the data for new royalties?
Yeah, that's one I'd prefer to answer in a closed door session, not in public domain. But yeah, John, feel free to get in touch and we can answer that a little bit more privately.
Sure. The other part of the advantages is that you're able to move. Part of the reason that these deals work for you and you source them in your network is that you're actually able to move very quickly on them. I use the example of the Dry Creek royalty and Corora Resources, having sort of watched that in real time as it came together. As you know, that not only was it you found a royalty that was in a difficult. In an unusual seller's hands, you were able to acquire and then move quickly against a company that was, Corora, who are literally actively buying back their royalties at that time. So it would have been a potential competitor in a bidding process for you. So maybe talk a little bit about that, how you're able to move quickly, and what are the things inside your company that allow you to do that.
Derek, that's a really interesting question, and to be honest, there's a very deep and wide-ranging skill set within our team, not just at the mine technical level, but at the deal structuring level. We have a great general counsel and a great CFO with some also really great finance background. And we've really kind of come together and created a system and a process that's always evolving in terms of how we go after royalty opportunities. And you touched on something that for us, really the biggest competitor that we have is operating companies that essentially might will likely bid against us when we're acquiring a royalty if they're involved in the process. So we have to be very I think strategic in how we approach opportunities, because for most royalty companies, their competition is other royalty companies. For us, most of our competition comes down to the operating businesses that are running these operations, because they would, typically they probably like to buy the royalty back on the terms that we're buying the royalty.
Right. Well, that's a great point. An operating company can buy the royalty back at up to 1x NAV, and they know more about the asset than you ever will, right? And you're at an information disadvantage in that case.
Well, yeah, and I would add to that, Derek. Sorry to interrupt, but I would add to that. In multiple cases, I won't talk about the specific royalties themselves, but I can tell you in multiple recent examples, there have been the operator came in after our deal was binding and essentially wanted to buy the royalty back at a very significant premium to where we bought the royalty. So it's again, there's a lot that goes into running a royalty business successfully. I think that's lost. I think there are a lot of market participants, whether it's on the investor side or also on the operating side of a royalty company, that think this business is very simple. At the end of the day, there's a lot of detail that needs to be done right. And our 40 years of combined expertise in the space allows us to be a lot more strategic, a lot more diligent and thoughtful in terms of how we bring these opportunities into the portfolio. Growing at this level is not easy. Growing at this level of value is not easy, and it takes really thoughtfulness throughout an entire team to be able to deliver what we've been delivering, and we'll continue to do that. But it is an overlooked element of our business, that is, to grow at this great value means you've got to be doing a lot of things right, that Vox presently is. Yeah,
actually, that value is something I want to touch on. It's something that I highlighted in my initiation report, and I think it's important to discuss here. On a NAV basis, effectively, you're buying assets cheaper than your peers. We just looked at the last 4 or 5 transactions. You're buying assets somewhere in the neighborhood of, by our numbers, 0.3, 0.4 times NAV. The average royalties acquired around 0.6, 0.7. So that's almost a 50% discount to where your competitors are transacting. What is it that we've talked about some of this, but is there some specific thing that allows Vox to be able to do that? And then also, how do you convince the market? How do you go about from here convincing the market that you're doing it that much better than your competitors going forward?
Yeah, Derek, there's been a couple things recently that developed to really prove that to the market. There have been a couple transactions, and out of respect for the other royalty players in the industry, I'll leave them nameless for now. But there have been a couple royalty companies that have actually acquired, subsequent to us, similar royalties over the same asset, and we can really kind of get into those details. And Derek, you touched on it in your report, which was fantastic, which absolutely speaks to our ability to buy royalties at better value than others. But we've also benefited that there have been some royalties that have been recently transacted on where basically you can draw that exact apples to apples comparison. Vox is buying at a fraction of NAV, where our competition is buying royalties that in most cases we actually passed on, where they're actually paying multiples more than what we're paying. So we have those kind of market precedents now, and I can tell you it's often 3, 4, 5, 6, maybe 7 times or more in terms of one of the knocks on Vox has been, hey, these deals look small. Well, if you multiply the purchase price by say 7 to 10 in some cases, these deals don't look so small anymore, and that's what other royalty companies would be glad to pay for a lot of these assets that we acquired at great value.
Well, I think that's an important point, but also I think the opportunity within that you guys are doing, what you guys are able to deliver is important, because if you keep buying royalties at that much of a discount to your peer group, you're effectively building a cheaper profile. And it's not to say the other royalty companies are buying them poorly, because they're still getting paid that 1.5 to 2 times NAV that we typically see with royalty companies, even though they're buying them at 0.6, 0.7, 0.8. But you guys are buying them better. If that is probably the right, probably terrible use of the English language, but it's the right way to describe it. But I guess the second part of that question was, how do you convince the market? It's something that's going to take time, right? People are going to have to build a track record. But how do you go about convincing the market? Because it's not that as simple as it is. It was actually, when we built our transaction database, we were able to look at all of your royalties that we had built our own models for and said, okay, this is what this looks like, and we kind of pulled pure multiples. But it's not that clean to do it. How as the CEO are you going to go out and convince people that we're doing this better than everyone else?
A lot of that convincing comes from the tangible growth within the portfolio. We said, we've got a very exciting organic growth profile. When you're a newly public company and seasoning and kind of your awareness in the public markets, I think investors are looking for track record. And we had the track record as a private business, but we were building that track record now as a public business, and we're seeing it. I mean, the growth, and as you've articulated well in your report on us, which we're grateful for, revenue growth is growing at an exponential level, and that's coming from really buying great assets at great value that others either didn't know about or didn't see, or just frankly weren't in position to execute on. Where we brought those into the portfolio, and we told investors there's going to be that we're buying quality assets. We can tell you that they're quality. We can tell you how it projects 3 or 6 months out down the road. But until we have that track record of really delivering what we said we were going to deliver, that's happened very quickly for us. Where there's 120,000 meters being drilled on our royalty projects. We have production increasing. We have revenue increasing. We have assets moving up from exploration into development at levels really you're not seeing with other royalty companies. And so I think as investors really start to, and your report is a huge help in this process. One of the negatives with royalty companies is we have 42 royalties and streams right now, and that's growing at an exponential level. How do investors kind of keep up with that? How do they know what you're buying? It's very helpful when someone like yourself took the time and diligently went through the portfolio, and then also is able to shine the light on, look at this growth that's happening organically that proves out the thesis that Vox is obviously buying at great value, and that value is expected to increase. And then you would expect, again, we focus on the fundamentals of our business. I think it's, very soon, hopefully here in the near future, those fundamentals prove out and are also reflected in the share price, which they are not right now.
No, I think they're not. I think that's a key point. And the advantage of investors coming in now, thankful those private investors and those early investors for you. A lot of that growth is already built in. It's already been paid for. So you're not out having, if you're coming in as an investor now, that growth is already, it is not priced into the share price, and you get the benefit of it going forward. And I think that's the thing that stood out to me as I was putting the report together, was just the magnitude of growth that you have relative to effectively all of your peers. But growth is still the key as far as being a royalty company and adding more. When you look at when you're looking at your next acquisition, so looking out ahead, what's the priority for you guys? Obviously, you talked about precious metals being the focus. Are you prioritizing cash flow and near-term cash flow? Is that something that's important? Obviously, at the early stages of the royalty company, even a $250,000 or $500,000 a year for Vox makes a huge difference to the bottom line, or over the next couple of years.
Yeah, Derek, another really good point of question. To be honest, we're always focused on value. If value comes in the form of cash flow, we're buyers. If value comes in the form of buying an asset that's going to produce over the near term great results for our investors and organic value for our investors, then we're focused there. It's always about finding value for our shareholders. We believe that over the long term, that's going to create the most return for our shareholders as well. There are certain royalty companies that have absolutely chased cash flow and paid a ridiculous premium in some cases for that cash flow. We've built, as you've seen, what is going to be a cash flow machine at very reasonable prices at great value. And so we'll continue to do that. For the right assets, we will pay more for, but they have to be the right assets, and they have to truly add value for our shareholders at a fundamental level. There are a lot of deals being done that I would argue are not truly adding fundamental value. They're done to kind of plug a hole in a company versus really taking a fundamental approach to how you're building your portfolio. We are capital allocators at the end of the day. We have to be very disciplined in that approach. There are plenty of opportunities that you can go out there and reach for, but in most cases, we have to believe in the fundamental value of the asset and of the deal at whatever price it is that we're paying. So if cash flow is always kind of top of the list, but if it's not coming in at the right kind of value for our shareholders, then we move on to the next opportunity that is.
Right. Now, when you look at particularly cash flow royalties, or those types of opportunities tend to potentially come with bigger price tags and bigger capital allocations. Is there something you would look to partner with other royalty companies on to help fund a larger transaction?
Yeah, absolutely. I mean, I think you're seeing it a lot more. Royalty companies are open to the concept of partnering. There are, like we've said, we typically avoid processes, but if we're kind of on foot with something that's maybe a little bit larger and would I would say strip some of the diversification that we've worked very hard to create within the portfolio. Right. We're absolutely open to partnering. We're in those discussions kind of all the time. Some may come to the table and some may not, but yeah, it's something that we're certainly open to. Again, we're always looking for ways. There's not a lot of ego in what we do. We're trying to just find ways to create the most value for our shareholders. So if that means partnering, we're always open to that concept.
Right. And then I guess the step beyond partnering is consolidation. And there have been in the last, I don't know, even 6 months, it feels like that every time I turn around, there's another new royalty company that's being created, and they've got a couple royalties and they're ready to go. And I see a lot of them for a variety of reasons in the seat that I sit in. Do you see? I mean, historically, the large players never let anyone get very big on the royalty side. Usually, small royalty companies had that one cornerstone asset, and then as soon as the royalty company got to a certain size, Franco or Royal or Wheaton Precious Metals would extinguish it, for lack of a better term, usually to the benefit of shareholders. That changed a little bit with Sandstorm being allowed to grow into a company, and we've seen the last crop of sort of new royalty companies in Mavericks and Metalla have grown, and now we have this new crop of royalty companies. What do you think that we're going to start to see some consolidation in the space? Because there are a finite number of valuable royalty opportunities. Well, you have a database of 7,000. I'm sure you would attest that not all 7,000 of them are worth buying.
True. No, very true.
Yeah. Do you see this? Do you see the potential that you could see a wave of consolidation in this space?
I do, honestly. I think there's a lot of companies out there that don't have an edge. That their only ability to grow is by paying more than the next royalty company. And I think at the end of the day, a lot of that will take care of itself with consolidation. I think you have seen some kind of breakout on kind of a peer-based multiple scheme where most royalty companies were kind of all valued, really, I would say more or less across the same kind of value spectrum in terms of multiples. I think you've seen kind of Franco and Wheaton and Royal kind of break out from that a little bit. And then, kind of the mid-tiers are kind of a little bit all over the map. But what that's doing is it's presenting kind of a accretive value for acquisitions that might not have been there, 3 or 4 years ago. And, I think there is going to be this consolidation that sweeps in on that basis where there is accretive value to be gained. But, there will be some that aren't acquired. And I think a lot of the acquisitions that have not happened is because, it was hard for an acquirer to justify maybe the kind of inline multiple that each company had, where I think you're starting to see that separate itself a little bit more.
Well, I guess it comes back to the acquisition multiples, right? If you're a royalty company and if you're Vox, you're buying something at 0.3 or 0.4 times NAV. If you're a more traditional royalty company, you're buying it at 0.7, 0.8. Whereas you'd have to go and buy to go even if you're a Franco or a Royal Gold, you have to buy something at 1.5 to 2, right? Which doesn't look as accretive as maybe the next royalty transaction that you could do, where you could outbid that potential acquirer. So it's a bit of a numbers game. I probably, as I started this line of questioning, the royalties is the ultimate financial engineering game. It's what has come out of it, and so the financial engineering has to make sense for it to actually be creative on the acquisition side. I'd like to see some consolidation, just because I'm having trouble keeping track of all the new startups now. But other than that, other than my own challenge, I don't think it's. I think that it would also be good for investors and be good from a deal perspective as well. Fewer people overpaying means that you probably end up with better transactions on an overall basis. I guess. I'll just ask the one more question that I do ask everybody, all of our companies we have on, which is about COVID. But your business obviously is very different. How has, your team is, knowing your team, they're all very remote, pretty much all work from home like yourself, but are in different corners of the world as well. How is your team managing COVID? I think for your guys' perspective, it might be more, completing due diligence on potential acquisitions, getting in, meeting with those, that pipeline, those people who help build your pipeline. And then, it's the secondary question to that: has there been any material impact on any of your underlying royalties?
Yeah, I'll kind of go in reverse order. There's been minimal impact. There has been one case where we have a royalty over a producing asset in Madagascar that has gone on care and maintenance because of COVID. They've also taken the opportunity to go back and really kind of increase the size, scale, and scope of the project while they're kind of under quarantine right now. So long term, that will pay dividends for us. But overall, with most of our assets being in Australia has been one of the most least affected jurisdictions because of COVID. So overall, we've seen very little impact to our portfolio. And we're fortunate in that regard. In terms of our team and some of the challenges it creates from a diligence perspective, a lot of the diligence that we're doing is the technical data that's made available either through the 43-101s or JORC reports. As we're not the originating party, giving money to mining companies and then hoping they say they're going to do what they're going to do, or do what they say they're going to do, we're in a different kind of market where really it hasn't slowed us down at all. But there are, say the larger private equity firms and even some of the larger stream and royalty players that are out there originating finance. They really need to get boots on the ground when you're talking about greenfield projects that are going to require a lot of capital. That if you hear the majors talk, they definitely say there's been some impact, and also the private equity groups, there's been some impact from COVID. However, what I would tell you is it's actually created a lot of an advantage for us. In the market, Derek, as you've probably seen as well, we've seen with some of the emerging players, the presentation shift, IP was never really talked about, bilateral deals was never really talked about, deal sourcing relationships around the world was never really talked about. Those were not core concepts to any of the emerging royalty players. We're seeing that change a little bit, but what COVID's really done for us is it makes, if you didn't already have those relationships in place, it makes it a lot harder kind of forming those and building those. So I'll be honest with you, I think it's done for our business, while we're empathetic to the businesses that it's obviously deeply affected around the world, it's probably helped our business more than anything.
Well, that's certainly to your advantage. And I think with that and that little bit of good news, I think we will leave it. We will leave it here. We're coming up on the end of our hour. Thank you very much, Kyle, for joining us today. I enjoyed this conversation. I think we were able to highlight the advantages of Vox very well. And I'd like to thank everyone for tuning in today. And I think that's a great, because this doesn't work without both Kyle presenting and you guys on the line to be here. So as a reminder, here at Red Cloud, we have a full slate of webinars on the go. See our media page for those for the full list of those webinars, the dates, and to register. And a reminder that our fall conference is coming up in a couple of weeks, and we look forward to seeing you there as well. Thank you very much.